Welcome to the source of commercial real estate, where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek, and today I am talking with Dave Codrea. Dave is the co-founder and partner at Greenleaf Capital Partners. Greenleaf acquires, operates, and services all of its investments it makes, and it's committed to long-term cash flow and driven investing. Dave has over 20 years in real estate, starting when he spent summers acquiring rental homes in Pennsylvania. He worked for Deloitte and earned a master's degree from George Washington. He launched Greenleaf in 2008, buying his first assets in the Atlanta area, eventually picking up and moving himself to Atlanta full-time.
Cool. Yeah, thank you very much. Excited to be here and talk through some stuff. There's lots of great opportunities still in real estate right now.
Yeah, Dave, it's a pleasure to have you here. There's a part of your bio that I didn't get to that I thought it would be an interesting part to start off with. So, something that is not commercial real estate focused, but you are passionate about adventure trips. And when I read that, my ears perked up and I'm like, oh, what is this? So, will you tell us a little bit about these adventure trips that you do?
Yeah, I mean, there's like a whole little subculture of adventure racing. And some of it makes it into kind of cable TV and you know, the Greatest Race and the scavenger hunt stuff. Like there's some of that out there that's pretty cool, but it is just a completely different way to see what's out there and pushes your body to the point where a little bit where you're very uncomfortable and fatigued and you kind of get to assess. I like getting to that point and seeing how do you make decisions in that environment. That's what I think is most I enjoy that kind of position and being in it. So the adventure racing and just doing just other kind of more off the beaten forms of travel, I've found to be very exciting and very rewarding in my life. I've done everything from like multi-day, hundreds of miles canoe trips and rafting trips and hiking and camping trips and all that kind of outdoor stuff where you get out there, you're experiencing something that's completely different than your regular, everyday kind of life. And you've got a totally different set of what are normally simple problems to solve at home that can become challenging when you're out in the middle of nowhere. So I enjoy trying to get in those positions and do that.
Have you read the book, The Comfort Crisis by Michael Easter?
I have not, but being too comfortable is a fear, I would say.
I would, just based on what you just said, I would highly recommend you read that book. Read it, listen to it. The book is premised based exactly on what you're talking about. It's just about how we as a culture have gotten so comfortable, and the basis of the book is he goes on this hunting trip to Alaska and he's out there for several weeks and he has to they all have to, he's there with a group of people, they have to hunt their own food, and so I think just based on what you just said, you would love this book. When I read that initially, when I read your bio about these adventure trips and being comfortable being uncomfortable, my ears perked up. I'm an ultra runner, and so I like going out for these long day efforts of running 50 or 60 miles and just getting really uncomfortable and being okay with that. So I have a feeling that this theme of being comfortable, being uncomfortable might come up a little later on in our conversation as we talk about investing. You've made a lot of transitions in your business career, so I'm really interested to hear about that. Why don't we start off by you telling us about a little bit more about your background? I read a little bit in the bio. Tell us about your background and a little bit about Greenleaf.
Yeah, I mean, my background is all finance, accounting type knowledge, right? So I was always interested in that. I'm still interested in that, and it's kind of like a pure numbers background. You mentioned I was at Deloitte. That's a great organization with some just highly talented people, and I was all in the finance realm when I was there and working on that and building models and understanding like what does the math tell you when you look at a problem. And if you've got good models and you've got good math and you can trust it, it certainly helps a lot. So a lot of my background was kind of around that. And then you apply that into a real estate formula and hopefully you're making the right assumptions and you can build a pretty strong long-term plan through that. I was always long-term focused, so was not looking at any kind of short-term flips, was not looking at any kind of, you know, fix this up and sell it type strategies. Everything was around how do I just build long-term cash flow and take advantage of the benefits of longer-term ownership. So that's really everything I've done from day one. Started Greenleaf in 2008, and it was around how can we find underperforming pieces of real estate, make them perform, and then hold them to generate long-term cash flow. We started in the residential segment doing that. A lot of my career was residential. And then over the past 8 years, really a little bit more than that, have been buying a mix of not only residential, but then also various types of commercial assets. When I say residential, I mean mostly apartment building stuff, not necessarily single families. That was single family was like really where I very first started on a renovation project. But the past bulk, everything at Greenleaf has been other bigger commercial and multifamily deals that we've put together going forwards.
So when I was reading your intro, I had to stop and cough, and I didn't get to finish your intro. So will you give us an idea of the scope and scale of Greenleaf? Your portfolio is extremely impressive. So what do you all own and operate today?
It's a good question. We've probably done about over 140 deals since we started, and we've got just over 2 million square feet. That's of commercial space. We've bought and transacted around 4,000 apartment units over that time, and then within that too, we've bought a bunch of different medical assets. We are currently buying vacant office square footage that we're turning into different uses, and we bought a bunch of net lease assets, which you think like a restaurant type thing, mostly all national branded restaurants. And then we bought about 30 mobile home parks as well. So we had a run with mobile home parks, and we bought a good amount of those. We're operating all of these things, and we still have a few of the mobile home parks left. We kind of entered that market as it was turning up, and sold some of that stuff. But yeah, so we've got a variety of assets that are operated. Everything's between Atlanta and Raleigh, North Carolina. So we're kind of just there's one highway 85 that connects everything right there. We really just go up and down that highway and look at every little town along the way. And if it's an opportunity that fits in how we can operate in a good spot in the market, that's what we're looking at buying.
Will you talk a little bit about your pivot or transition from residential multifamily to a more brotter asset, asset agnostic philosophy?
Yeah, I mean,
Will you talk more about that?
Yeah, I think the biggest difference is obviously the tenant, but the buildings, when we look at real estate, and I go out and say like, hey, what am I trying to buy here, and where's the value? When we look at it from an operating first standpoint, we're typically buying 1 and 2 story buildings. So 1 and 2 story brick buildings. A lot of stuff in the market that I operate in, there's plenty of stuff that was built in the 70s to early 90s. In that vintage, there was a lot of construction then. So there's a lot of those opportunities to buy that stuff. And over the years, many of those things have been moved into an office user, or maybe they're already moved into a warehouse user, or they could be residential. There's a mix of phases of life that those buildings have gone through. So I'm looking at it more from this is a type of asset that I'm comfortable operating. And then how do we build a team and process around going and putting the right user in that space? So some of the very first commercial buildings I bought, they were, from the outside, you kind of look at me like, what is that building? Is that an apartment building? Is that a office building? Like, what is that thing? And that was kind of a natural progression because it was a building that we knew we could maintain. It was something we could fix up. We could do the work on it, use our same team, and start learning more the commercial lease structure. So the biggest change is really just how the leases are written versus a residential lease. But that's if you kind of sticking to a geography, sticking to a construction type. We didn't go out and say, hey, now we're going to start buying towers downtown and have Fortune 500 tenants. We don't have any of that. So I imagine that's a different world. There's all these different avenues in real estate, and all of them can be eye-opening at how different they are.
Dave, you started in real estate in the residential world, and you've bought a ton of multifamily, and at some point you transitioned to non-residential stuff. I know you still own residential stuff. I imagine there's people out there listening right now who started in multifamily. I'm one of them. I built a portfolio of small multifamily, but now I'm focused on non-residential assets. Will you talk about your kind of what was the impetus? What was your motivation for branching out beyond multifamily? And will you tell us about those first couple of commercial non-residential deals?
Yeah. So moving or broadening from multifamily, one of the first things we did was looking at net lease buildings. And again, back to the very beginning, we're always trying to find stable cash flow plays. And gosh, quite a bunch of years ago now, I'm not sure, but we started looking at how can we buy some of these branded national chain. They have a very strong balance sheet. They are excellent operators. If you look at some of the just larger restaurant chains that are out there, one of the ones we like a lot is Zaxby's. Like, they are a good operating business. So I'm attracted to that when I see like this is how a business operates and it's very well put together. There's lots of franchise opportunities you can go see and you can look at them and they perform phenomenally well. We like that concept, and buying one of those locations is a pretty stable play. Now, there's not a huge amount of upside because there's not a whole lot of value to add there, but we got in and we could extend leases and try and get longer term leases in play. And it really provided some great current cash flow. That was some of the first commercial deals we were looking at. Were in that avenue. And they are kind of dictating the lease terms, right? Zaxby's isn't just going around and being like, hey, we'll sign whatever lease you guys want to send us. No, they know exactly what they're doing and they have strong real estate teams. So there's not as much to negotiate on that side, but they're a great user of space. So, and then outside of that too, then we started looking at just like, where can we get into value add on the commercial space, or taking a building that's dilapidated and needs some love, and what can we do there? And a lot of that was getting into much smaller size tenants. So 1 to 3,000 square foot commercial spaces. So you could buy 50,000 square feet that's divided up into much smaller bays or smaller offices and layouts that those are a lot easier to rent right out of the gates. So that's really how we kind of like got our feet wet of operating, was on smaller scale tenants. And the majority of our space right now is it is sub 5,000 square foot users. That makes up 90% of what we do. Occasionally there's a bigger user, but for the most part, it's all smaller operators that are occupying that space. And we're comfortable in those conversations from a management standpoint, and we're comfortable doing the work required from a maintenance standpoint in those locations.
If I can identify a theme so far from our brief conversation, it's opportunity. It really seems like you and Greenleaf are opportunistic buyers, and given, you kind of you want to play the hand that's given to you. And so earlier you had mentioned buying vacant office buildings. And so I want to go there. And you have a great YouTube channel. I saw a YouTube video that you put out recently of a project that you're working on. You bought a vacant office building and you are converting it to flex space. Will you tell us about that project, about that video, and why you like that strategy?
Yeah. Definitely opportunistic, and opportunities don't last forever. So there's a phase in time when things are a good opportunity to take advantage of. Right now, we see that only in the single story component of the office world, predominantly in brick buildings with a lot of parking that are more suburban locations, but have a lot of stuff built up around them and good traffic. So it's like they don't exist everywhere, but there's a small segment of when you say office that is that. And what we've been able to do is identify those assets where the building structure and the bones of it makes sense that you could divide it into a 5,000 square foot flex space where you walk in the front door, you leave 2 or 3 of the old offices that are there, and then demo the rest of the space up to the up to the metal roof, the rafters right there. And again, it's only one story, so there's nothing above you. And then you put a roll-up door in the back, and the parking lot is large enough that you can get box trucks and turn things around, and the zoning still works. So there's not a whole ton of them. We've only really been able to identify those things. We have a few in Charlotte, mostly in Atlanta, where that happened. We joke around internally that you had to have had some suburban sprawl to get these things built in the 90s. So that's what we're going after right now. We see that as a current opportunity. Don't know how long that will last for. There's not that much of it out there. But it's one thing that, we've bought a few deals. We see that we've got probably another 12 months of opportunities there to find stuff that we can kind of keep that rolling and hopefully provide some great value buys to our investor base and then build long-term cash flow with the users there.
The strategy makes so much sense. I know people listening to this are going to say, of course, you have this office asset class, which in some areas and some locations is really struggling. Flex is on fire. It's really hard to build flex with numbers that make sense. It's hard to build anything with numbers that make sense right now. So of course, office to flex conversions makes so much sense. Will you talk about some of the struggles, some of the challenges that I know you can't do this with just any property. So talk about some of the struggles that you all are going through in identifying this and executing it.
One interesting fact, like we bought one of these deals and we're like, okay, we're going to go in, we're going to demo the office, convert this to flex. And it was a typical building that's brick and it had some windows every so often around the outside, like, the office windows where you can't see in, but you can see out, right? They're tinted windows. And as we started getting into it and touring the building and everything, it still had the roll-up doors from when it was a flex use 30 years ago. So like it had come full circle. Like it was built with concrete pads out back that they just boarded everything up, turned it into more like a call center location. And so we went back and really just converted it to what it was 40 years ago, right? 30 years ago. So, those things are there. We were super excited about that deal. It's been good for us. But, along with anything, there are challenges to getting anything done. And the biggest stuff in office is, for the most part, office buildings have a lot of power. They have really good power coming in for users, which is phenomenal. But anything you're doing, if you're going to divide up one big space to a smaller space, you now have to split apart all that power to get it to the right spots, right? You are making some guesses on like what size unit here is going to be a good, right? Like what's going to be a good product? Is it 3,000 square feet or is it 6,000 square feet? Like what is it actually? And knowing what's the most effective way to divide up the space. And sometimes the property is really dictating what you can and can't do based on where the support beams are. We're not trying to go in and heavily mod that stuff. So we're saying, look, if the support beams are all making this 4,000 square feet, we're going to go with 4,000 square feet. It's kind of like a path of least resistance to make sure our basis is as strong as it can be. Because we definitely believe from an investment standpoint that basis is really everything. And if we can offer a clean product that's good at the most attractive rate, we'll be able to have occupancy and we'll have long-term cash flow because of that. So that's really what we're going for. Other challenges, just getting things mobilized to do renovation work right now is a challenge, right? There's not a ton of bank financing for the CapEx work. A lot of our local banks have really been our best partners even since we started in 2008. And they understand kind of local impact and vision better. So they're still actively involved in many of the deals that we're doing. We haven't really gone to the larger lenders. That hasn't worked out as well for us, but there's only so many local banks too. So we can only, you can only do a handful of deals at one time, which is also probably prudent anyways. So, but yeah, working through CapEx draws and bank financing right now is definitely a challenge, but it's still doable.
Will you talk a little bit about the numbers? And they don't have to be specific to that office to flex conversion or reconversion. That's a pretty funny story that you were just
Yeah.
changing it back to what it was 30 years ago. But I'm thinking about a listener and even a certain podcast host. I mean, I toured a building several months ago that would fit this exactly. What sort of metrics or numbers are you looking for, kind of big picture wise, to make something like this work? Can you talk about like purchase price per square foot,
Yeah.
rehab budget price per square foot, and then lease price per square foot to kind
Yeah.
of give listeners an idea of what could potentially work?
Right. We're trying to get our rent to be 10% of our basis. That's kind of like our minimum where we're going. Right. So if we got something at 100 a square foot, we need to get at least $10 in rent. Right. In the commercial space, you've got your base, that's your base rent. Plus, if there's any CAM reimbursements or escalations, 10's got to be the starting point when we're looking at something. And again, we're looking at least a 5-year hold. So we're like, that's our starting point, has got to be 10%. So we could be into something for 120 square foot. That means we got to start at 12. So we got to, however we want to get to 120 square foot, we could buy it for 80 and put in 40 a square foot, as long as we can get at least 12 on the base rent in year one. And that's no concessions, no number finagling, no like, oh, it's 12, but they get 3 months of free rent. No, like actually 12. Right. So in the Atlanta market, we can be into stuff in the $100 a square foot range. And we have pretty good occupancy and demand in that 10, a lot of times really up to like 12 and 14 a square foot is doable right now and attainable in the markets we operate in. But our math with the financing that we use, I mean, we're typically around 50% equity right now on a project if we're going into it. And that's where we got to get our 10% base rent on price per square foot. That's kind of our number one metric to go after.
That's a really easy and kind of cut and dry metric. So thank you for making it so simple for people like me. What sort of I think there's a certain expectation that there's a fire sale on vacant office properties. Are you seeing ridiculous prices on vacant office properties right now?
No, most of the times when we've bought office, we're not buying it from people that are like, oh man, we're gonna lose the farm here. Their commercial space is typically pretty well capitalized, especially coming out of 2007, 2008. These things didn't necessarily get like super leveraged. It's more, the cost to go do an office TI build out right now is very high. So what I've been able to gather is people are more gathered like, look, we don't necessarily want to go reinvest all this money to do something, and they're not going to want to do the conversion. So we have an opportunity to buy it at a decent price and do a TI package that's a lot cheaper than what may have been out there in the market and find that different user. But no, there's no like fire sale of stuff out there that we've seen.
And as far as rehab costs in general, kind of back of the napkin math kind of stuff, is there a certain budget price per square foot that you're budgeting for some of these conversions?
Yeah, a lot of ours, we liken it more to reverse rehab, right? So we're taking things out and getting it back down to just, concrete floors and open ceilings that we're painting. So we can do that for just under $10 a square foot is what and that's our age building, 14-foot ceilings, lots of room to work around outside so people can get in and out. Not a ton of office build out. Typically our spaces, they only have offices around the corners and the middle was open for like a call center kind of environment. So you got a lot of cubicles. So that's kind of where we're coming from. Office build outs can vary tremendously though. If you've got a build out that's got a ton of glass and office, like actual offices in there, like your build out cost or your demo cost could be completely different based on that.
Dave, let's go into management. You've done over 140 deals over the last 20 years, and you've got an extensive portfolio of multifamily, office, flex, mobile home parks. Will you talk about, yeah, just give us a broad overview of what I'm assuming you all manage in-house. Correct me if I'm wrong about that, but give us a broad
Yeah.
overview of how your team can manage such a diverse portfolio like you have.
Yeah, we definitely do manage everything in-house. So we're operating our own stuff. So we look at it like an operator first investment company. We want to know exactly how things are going on the ground, and that requires us to be on the ground, looking at things on a daily basis, right? So we kind of divided our teams up into little pods where you have a group of people that have varying skill sets, right? Someone might be focused on leasing. We have people focused on maintenance. Some are focused on like the service and the back end kind of stuff, depending on personalities and skills and where they want to be on a team. And that group is going out and operating a pool of properties on an ongoing basis. So, and they're compensated with profit sharing of how those assets do, and are empowered to really go out and be like, what can we do to make this property better for the people that are there? Any of the users, what can we do to make this place better? Because any user really only we can control two things. We can control the quality of our property, and we can control the price. And at some point, if your price and quality are out of whack, you're going to have vacancy. If your price and quality are aligned, you're going to have occupancy. That's really the only things it kind of all boils down to that. You can have a super crappy building, and if you charge 50 cents in rent, you're probably going to have someone that's in there. And you're like, that doesn't mean you're a great operator. That just means, hey, you're able to have a price point that you're going to get someone in there. It's going to be occupied. But at some point, at some price, they would leave. So we're trying to make sure that our quality, we judge our retention rates are really what indicate whether we are operating at a level that matches the price point that we're charging.
Dave, you're especially knowledgeable about finance and underwriting and risk assessment. Will you talk me through how you are thinking about risk here in 2024 across all of your different asset classes? Is there some strategy or method to the madness that helps you reduce risk across all of your asset classes? Are there certain assets that you view as higher risk right now as we're talking? Talk to me a little bit about how you view risk right now.
I mean, probably a little bit like more in the weeds assessment when you're looking at risk adjusted rate of return, where you're taking multiple asset classes and you're saying how risky is the current environment for this type of an asset versus another one. I'd say an example of that was we were buying net lease deals right after COVID. If you look at 2020, 2021, and you could have a chain restaurant and a mom and pop restaurant, right? And they could trade at a similar price-ish. But the risk associated with a very small operator versus a national brand is vastly different. Especially if you look at their ability to access to capital, access to training, access to resources and a team and leadership. It's like they had a lot going for them. So we looked at that and say, wow, this is a lot less risky than having an independent operator location. And therefore, the risk adjusted rate of return is a lot higher compared to what was in the market. So there was kind of like a disconnect because the market wasn't necessarily pricing those independent operators significantly higher on the cap rate stance because debt was still really cheap at the time. But I think the national ones came through things a lot better. And we had both at the time. We had both types of tenants. We had a lot more challenges with our individual ones versus the national ones. So we shifted everything to be the national players when we were looking at that risk assessment there. The other way we look at risk too is just like whatever is the most interesting thing of the time, the risk is probably being a little covered up. So, whatever sounds like it's the greatest is like there's probably parts of it that are being missed right now. And that's really why we really stopped buying residential type assets in 2019 because the margin compression and the expense ratios to revenue were just headed the wrong direction, and we could not mathematically think ourselves out of that one. So to us, that's like you've got risk from operating, you've got risk from expense controls, you've got risk from just what are your taxes and insurance regulations in a state. Those can vary, those can vary a lot. And I think California's had a lot of issues with insurance rates and insurers leaving that property, both in the personal and commercial. And then different states and their property tax laws certainly change your risk appetite for investing. So knowing all those factors and making sure you understand like, hey, this is what I think. These are the variables I'm using, and track your performance to see how you do on those assessments.
I think this goes into nicely. You and I were having a conversation. I think it was before we hit record, but you said something along the lines of you're paying attention to the bad news and the challenges that are out there in the marketplace because that creates opportunities. Will you talk a little bit more about what bad news and challenges you're paying attention to right now and what opportunities that's creating for you?
Yeah, I mean, I mentioned a little bit too, like the bank financing world has been pretty tight lately, and it's it seems like our banks are in a good position overall, which is good. But there's definitely less lending that's available, and especially for things that are CapEx or improvement driven. So it's like, okay, you've got a negative situation, and on the positive side of that, that means there's opportunities out there to go be that equity side for an opportunity or pick up things that are at a discount. We recently invested in some notes under that premise that there wasn't a lot of financing for the notes anymore. So we provided capital for those notes. And I think we're going to get an attractive, 5 to 7 year return from that. And the other bad news, I mean, the most bad news right now is just around office. That's where everyone's been the most negative. So it seems like there should be a good opportunity to buy stuff there and figure out what is the solution to a lot of space that's not being well utilized. So that's where really, like, if people are running from stuff, there's a problem to be solved and figure out that's worth putting some time and effort into.
We talked about your office to flex conversion. Are you doing anything else creative with office? Are you buying traditional office and just trying to fill it with office tenants? Or are you doing anything with office properties right now?
I mean, we own office space that we are leasing to actual office or commercial users, but a lot of that is right now is a lot of medical and lab space. That's been one of the bigger users of that type of space right now. So we have a good portion of our portfolio is occupied by those tenants, and that's a much longer lease, even for a couple thousand square feet. If you're building out a lab, it's way different than building out flex space. It's not $10 a square foot. It's like hundreds of dollars a square foot. We like those opportunities. They're just they are much longer to play out, whereas really speed I see as just a very important factor, and we can take the single story office and get it to flex pretty darn quickly. So that's really the one that we're focused on as the opportunity that we see right now.
Dave, we're getting towards the tail end of our conversation, and I love having these conversations with people like you. You're so knowledgeable and so diversified. I feel like we could talk for an hour or two just about the different asset classes that you're invested in. But I'm going to finish up with a few questions. They're designed to be more quick hitting questions, but if you've got a great story to share, feel free to take as much time as you want. If you could 10x a certain part of your business, what would that be and why?
We operate our teams. I mentioned how they're operated in pods, and we run this structure where we have goal meetings every quarter. Really, it's a team of people that get together and they plan out what goals are they doing that quarter and what have they accomplished, and how can the people around them help them achieve more of those. believe as an organization that if we just have a group of people that are goal driven and successful, by default, we'll have a successful organization. So if I could 10x the impact that our goal meetings have for my team, I would love that. But default, we'd be better if we could just accomplish more and more goals. I mean, there's some limit to what you can accomplish in a quarter, but that'd be the biggest thing. I think it's a very impactful part of our business and directly impacts the lives of the people that are our team members here. So that would be the biggest one for me, is how do we 10x the impact that could have? And that would be something special.
What's the best deal that you've ever done?
It's always the oldest deal you've ever done. We bought an apartment deal, our deal number 8, and we still own it today. It's in downtown Atlanta. It's a phenomenal deal. Our basis is fantastic. Our returns are excellent. We've got at least a dozen funny stories of like, remember when that happened, and it's back at that property. It's like, so just, it's got good memories, good investment returns, and it's something we're very excited to own. So that's probably the best one, thinking about it. But also too, deals where you went in and got your hands dirty are always the most memorable. And I feel like those just have a special spot in remembering how we built this organization and kind of where it came from.
What's the worst deal you've done?
Some of the mobile home parks that we invested in, we underestimated the challenges that we were going to face. So there are some hurdles in that operating space, not necessarily on the investing side, but in the operating space that are significant to get through. So in Georgia, there was just a law recently passed where, if a mobile home is damaged or destroyed, that they passed a state law that you can replace that. Prior to that, it was every municipality in every town. So if anything happened or one got damaged, you couldn't, if the county or city or whatever municipality said you couldn't replace it, you essentially lost a unit and there was nothing you could do about it. And it's like, well, because they would change the zoning or change the size that had to be there or the layout or any one of those things. So, there are some definite operating challenges going into the mobile home space that we overlooked. So I would say that was probably the hardest one that we went through.
What's your top tip for finding deals right now?
We have some long-term relationships with a few great brokers here in Atlanta, and finding a deal, yes, is important, but being able to actually convince the person on the other side of the table to sell it to you, like, that's more important than finding it, I think. We found some great deals and haven't been able to close them. So it's like, does that really count? It's like, I don't think so. But, we got some relationships here in Atlanta that have been fantastic over a 10, 12-year period. And that's really driven, the success of our organization.
What's your top tip for raising capital or working with investors right now?
Transparency. I think that's as transparent and as clear as you can be in what your intentions are, what you did well, what mistakes you made. I think that's the most important. That's the most important thing to me. We try and do that as much as we can. We are certainly not invincible. We certainly make mistakes, and then just trying to be as clear as possible. Like, hey, this is the mistake we made. This is what we're going to do about it. This is how we're going to learn going forwards. But we're making mistakes all the time and learning from them. It's a natural part of operating, and being as transparent as possible is really what I think is most helpful.
Dave, this has been a great conversation. I could have talked to you for a few hours today, but I know your time is valuable. I sincerely appreciate you taking time out today, sharing your expertise with us. Was there anything that you feel like we should know that we didn't hit on today?
I just, knowing, if you look at Greenleaf as an organization and our team here, it's one that's just driven to go find, like, how can we improve the places that we operate in? That's our goal on a daily basis. And we look at it from an operating first standpoint. So,
and if people want to connect with you or learn more about Greenleaf, where would you like to send people?
I've got all my information on LinkedIn or our website, which is Greenleaf mgmt.com or Greenleaf Management. So everything's up there.
Dave Codrea, this has been an awesome conversation. Thank you so much for joining me. Sincerely appreciate you sharing your time today.
Yeah, enjoyed the time. Thank you.
Listeners, if you enjoyed this conversation, feel free to reach out to either one of us. We love talking about commercial real estate, and we would love to connect with you. Thank you so much for listening. Until next time, take care.